Get ready to roll. I'm hype. Open chat. Let's go. Let's go. Good morning. Love you guys. Hit that like button. Let's get ready to get started. Looks like market's opening a little bit to the downside. Double checking everything that we got through the pipeline today. Have any earnings, any good stuff? Any data points, PPI? That was hold on, let me refresh this guy here. Retail sales. Yesterday's PPI. Today retail sales. Nothing looks alarming. Just a normal day. Yesterday there was a catalytic event we talked about. We have a new triple B today. We're gonna go through and show you guys how to calculate that. Have a session today on VIX. We're gonna redo the VIX video and other things. We love y'all. Time to get started. 3 minutes in, and we're getting ready to roll. Also, it's in black and white. Yeah, it's the intro screen. Have to have the cinematic flair as we go. See, there we go. Silly folks. All right, let's go. What's up? Now it's big. Now it's color. Now I'm back. What's up, guys? Okay, hold on. Hold on. How do I look? Do I look vacationed? Rested? How's the part nice and clean? All right, good. It's all that matters is like the razor sharp part, and then we're good. Good morning, team. Good morning, folks. Let's get ready to roll. We're going to take a look at some of the news we had today. Remember, yesterday there was an event, and I'll explain something to you about volatility. The third Tuesday of the month, the market's extra sensitive to random news, right? Random catalytic news that really is not going to do anything to shape the landscape of the stock market. What we had was missiles got shot out of the air, and some parts of them fell into Poland. Unfortunately, killed 2 people, and there was a market just like this. What happens on the third Tuesday of the month is that any news that can shock the stock market can cause a call squeeze. VIX options on the monthly expiration expired the third Tuesday of the month, which was yesterday, and we start in 1 minute, so get ready to go. We need to do a new triple B calc, which I'll do really quick. Running out of time here. And so any event can cause the market to be very sensitive. What happens is any trigger whatsoever can cause what happened yesterday. And it's just a volatility squeeze. Fixed calls go in the money very rapidly, which causes the market to completely lose the floor for a second, then come back to normal. Okay, your triple V is right here. This is for December. This is all I wanted to see where we were. We're opening right at it. There needed to be a test for it, and as long as we go below this, it's bullish for another month. This is the whole thing. It might not make it there today, but we will see. Right? Okay, market's open. Write this number down and remember it for a month. If you learned anything from me today, it's this trick right here. This number, VIX futures. Write it down for a month. You will love me when you use this. As a gauge, the contango builds in a month's worth of expected volatility, especially in a bear market. This is even more important. You usually in a bear market will support off of this line and just hit it, ricochet, and go. It's kind of like re-entry into Earth when you're in outer space. As soon as you hit it, you either bounce off of it and go for a month, or you fall through it and crash land on the planet. You want VIX to crash land into the planet. Let's go to the analysis here. There is no irrational sign on VIX. Let's look at the bands here. Nothing on RTY, nothing on ES, and nothing on NQ on that irrational setup. So that's pretty good. In the news today, nothing really big coming up on the news. So we can take a look at the liquidity map up. Let's go back to the front and center. We do have a bunch of new features. They came out yesterday, but I didn't really go over them that much because I was on vacation. Well, actually, I was at a wedding. So there wasn't much vacating going on, but I did do an escape room, which I love doing. So Hit that like button, folks. Let's get ready to go. We're gonna run our calcs in the morning. See what we got for S&P. Ooh, that's lovely. I got the numbers here. Let's see. We got a 0. We haven't had hedge pusher come in yet. Good morning. What was the number? The video chopped up and froze. Which number? You talking about yesterday? I'll show in a second. 25.49, I think. I'm waiting for the numbers to come through. There are calcs in here. $25.45. Thank you very much. Let's take a look. Let's pull up really quick. Hold on. All right, so I'm long QQQ, long Apple, long Google, same as I was last week. Those ran up a massive run yesterday. It was really good. I'm still hanging in there, not being scared of that trade yet. I hope we get a move today, at least a double topping move. If we get that 152 in Apple, I'm going to be pretty happy. Google, my strikes are 100. So like I said, you saw the print yesterday. It was a massive, massive up. Oh, let me put the date in here. Something wrong with MHP on SPY? Yeah, that's very odd. I'll double check on this. What about... Oh, there it is. There it is. There it is. It's just late coming in. Looks like the data hiccuped for a second. All right, let's go. We're on SPY. So we have it. 396 and 398.5. It looks like a drawing anomaly. That's really, really interesting. So on the classic app, 398.5. Don't know why it's drawing it that way. They did some drawing updates, so maybe there's a little bit of a... All right, let's go. So we are at 397.55, which means let's do this manually. We're stuck between the two, so it is an up. I'm sorry, it's a down with an L, and it's mean reversion long down, MRLD. So mean reverting, it looks nice and good. So all I need to do today is a very simple, it's a 396 long. I don't know why it's drawing it this way. It's a little bit of an interesting anomaly. Let him know that. It's just a drawing. Oh yeah, the new dashboard. You guys like it? Super cool. This is a drawing thing. 398.5 is it. So let everybody know that in chat if you don't mind. Drawing anomaly. Okay, so mean reversion long down, sandwich between the two. It's a long off of 396. If you're a bear, it's a short off of 398.5 or 398 against the bull zone. Two sandwich in the middle. There's going to be a consolidating day. It'd be very weird for this to break out unless we have some expectations on some good earnings. It'd be very weird for this to crash out unless we have a volatility event. So we're going to watch that triple V nice and close. No irrational market yet. All vol pre-market checks. Things are nice and clean. Yeah, we're getting some hiccup. Like we're not getting all the data in yet. So I'm taking it again. We got the main ones in this. So UVXY, let's just the analysis really quick. So UVXY, yeah, we're missing, looks like half the data. I think the data pool is froze. So let's take a look. I got them pulling it manually right now. So what happens is we pull it from our own servers. After we get the data coming in, that's just how much data we've got funneling into the res calculation. White res is good. Yellow res is still got half the stuff needs to come in. So we'll see what's going on there. BSD on VIX, let's take a look. So VIX is right here, BSD. If you get a liquidity map, go to the Discord. You guys need access to this to see how we call our shots in the market. Go in here, get this liquidity map drawing. It's in our Discord. You can have it. It's really awesome. It's really fun. I use nothing but it when I trade. BSD, this guy resisting blue is great. You want to see VIX resist there. However, team, what's the concern today on VIX? Let's see if you guys remember. Yeah, there's just a drawing anomaly on SPY, which is kind of odd. Let everybody know that. Right then. Okay. Right here. So BSD, obviously resistance here. What is the concern? New BB reversion, yeah, 25.42. Thank you. I think KRG shared it. Okay, what is the concern here? It's 9 of VXY on the bounce. You guys see this? VXY and decay is a good sign, but remember what happens when you interact with call wall. This is an irrational setup. As soon as you touch this, the irrational flag will turn red. Boom. The market can very rapidly run from here. You all understand this? Pop that like button real quick, everyone. Scroll down and hit that really like hit it like hit it like it drank the rest of your Celsius and you're mad, right? Hit it like tickets pop out of your computer and you can go get prizes like at Dave & Buster's. Whack them all. Here, wait. Let me remove this. All right. Quick. This right here, irrational setup. The minute you hit here, it is irrational. It's just on the edge. Do we all understand this? Okay. Once you touch this, irrational, and once you go below 9, it's not. Rational break below, you nailed it. So the minute you touch this, there will be volume on VIX and the S&P will start to play very violently. Let my team know that the data pool is frozen. You get a manually liquidity map. I don't know what's going on here, but for some reason, the liquidity map, since the update, it is not getting MHP, but we do have it. For whatever reason, it's 398.5. So something strange was going on. And I'm gonna say, if I had to guess, we rewrote our black box equations because now we have the new CBOE option schedule. We'll talk about that today, actually. So CBOE now released Tuesday and Thursday options. If you guys understand what that is, a great little lesson today on kind of risk and volatility. You can now trade Monday, Tuesday, Wednesday, Thursday, and Friday expiring options for SPY and QQQ. However, instead of what it used to be Monday, Wednesday, Friday, that you can buy up to, I think it was 5 weeks out, right? From Monday and Wednesdays. Instead, you can buy Monday, Tuesday, Wednesday, Thursday only they're only carrying 2 expirations out, which means you can only buy 2 weeks out. And I believe that's for the Monday, Tuesday, Wednesday, and Thursdays. The Fridays are still, I believe, 6 weeks or 5 weeks, 5 or 6 weeks, something like that. So what they did was they added more options to more dates to choose from, but you can only go not so far out in time. Now, remember, if you remember the volatility equation, something neat is that the further out you go in time, if I were to buy strike 300 tomorrow versus strike 300 for a month out, the one for tomorrow will add more to the volatility equation than the one further out. So, you know, essentially what they did, very, very interesting what they did. See, if you understand a little bit about how exchanges work, this is an interesting, yeah, it's really neat. It's great for us. So we wrote the black box equation. So my thought is that since we're actually pulling more data, there might be a zero that they kick through the pipeline and it crashed something. We'll have to double check it. But since we're pulling all of our liquidity maps from, the monthly mode shouldn't have changed though, which is what has me concerned. But we're checking on it now and looking at it. So what they did was add more options. And so right now it's mean reversion. We're gonna wait right now for VIX to hit 9 UVXY. And then from there, I'm going to see what I'm going to do. If it hits 9 and bounces, and breaks through hedge pressure, I'm going to close all of my positions. I made almost 100K on that trade. I'm going to close it all out. So keep an eye out. And I'm going to dive right back in maybe tomorrow. So essentially, VIX equation is a really neat thing. I'm going to give you guys some quickie little math. If y'all like the math, y'all like what we're talking about, and I'll show you my play. We'll show you the plays I want to look at today in just a minute. Hit that like button, please, and get those numbers up. We'll get the channel growing. VIX is equal to some function of two terms: x over t. Is x over t? Y over t, right? Something like that. A little white paper here. And what happened, why the CBOE released more options. I'm going to teach you guys something every single time while they're here. It's actually VIX square. So you have like two terms, right? And you have some term over time and some term over time. The first term has to do with the probability at which the option goes in the money, and there's all the terms in it go into the risk-free rate to expiration. That's one of the terms. The midpoint of the bid-ask spread for each of the options. So as you, an example is if you long, something, there's a bid price and ask price. If you long something, then you're going to clear out tiers of the ask. And so the midpoint gets higher and higher and higher. Okay. And you sum up all the things and all the options. And then you subtract another term, which is related to the forward index level. It's a whole different thing. But essentially, when you look at the VIX, what it essentially tells you, it's an equation that talks about the demand for options. And it's a ratio, if you array, it's like it's a number that talks about the demand for options near the money versus the demand for options puts or calls out of the money. And then it also factors in time into the equation. So if you start buying massive amounts of near the money options, VIX is going to go up. If you start buying massive amounts of out of the money options, VIX will go up just a little bit. If you buy massive amounts of any options, like you're just nailing one side or the other, raising that midpoint, nearer to expiration, VIX is going to go way up because that's in the denominator. You put a lot smaller number there, the term goes up. If you buy them further out in time, VIX goes up, but not as much. So ideally, if you look at VIX as a very simple thing, like if this is like where you are trading right now, if everybody is buying today's options right here, like right now, VIX is going to start going crazy. So what happens is if you start just slamming options or like people start immediately rapidly hedging options like, oh shit, I need protection right here, right now for today. That's why VIX goes like that yesterday's news event, right? If you're in a position that the market starts collapsing and those options expire today that you buy, people have to come in. If I buy options right now that are in the money, like the market's tanking, I'm in a long position, I start buying puts right now at the money, then I'm forcing the person that sold me, example puts, the person that sold me those puts to immediately come in and start shorting right here, just so they can have the ability to buy back when I sell to them because I have puts. So now shorting pushes the market lower, which forces more people to buy options, which causes more shorting, etc. And the market does this. And so when you get that massive rapid effect, VIX just goes. And also when you have VIX calls on Tuesday that expire, because you have monthly calls and VIX expire on Wednesday morning. So Tuesday is the last day of trading. So what happened yesterday is any news event that has nothing to do with the global economy, US stock market, United States not going to war, is that Tuesday, on the third Tuesday of the month, there's always strange expiration mechanics. We're investigating. We don't have DDD yet. What happened was in the middle of our data pull, something stopped. So he's looking at resetting it and repulling it. Not really sure. So in the meantime, I'm going to explain to you what happened yesterday, and I'm waiting to see what we get. My action is only off of S&P there. I'm going to watch UVXY at 9. Until then, I'm not doing anything. So we're going to watch. The second thing that happened is as the VIX starts going up, right? People start longing the VIX, which has those VIX calls that have been sitting there basically in the money, right? Not in the money. So call sellers of the VIX have been sitting there pretty for a month, right? And all of a sudden they start throwing those in the money. Then they start having to long the VIX rapidly on the onset of the event, which is what you see. We call them a call squeeze. And a lot of times on the third Tuesday of the month, now this is a real news event, not to say, but a lot of times on the third Tuesday of the month when old DT was president, the last administration, you'd get a random tweet like right 20 minutes before the market would open. Oh, we're going to go to trade war with China. You know what they do? Wall Street knows that you can induce a market dip on the third Tuesday of the month very easily. It's part of the whole everything in Wall Street's fraudulent theory, right? Everyone plays somewhat dirty, and all you have to do is over-exaggerate anything that day, and all of a sudden, the market's nice and steady and nice and bullish, all of a sudden, oh no, catastrophic event, all the news is on it, and then the market recovers, right? The third Tuesday of the month, there's a rule of thumb, and somebody said something funny on Twitter yesterday. They said something along the lines of, you always buy geopolitical, sky is falling, we're going World War III news on the third Tuesday of the month, and I 100% agree. It's funny because what happens is your VIX monthly calls expire, right? And you just start throwing them in the money. It's so crazy. So essentially, right, people short the VIX and buy calls just in case it blows up, and people are just buying calls, all of a sudden you strike them, and then it causes a cascaded reaction. As a matter of fact, I wish I had the liquidity map still here and we were live when I did it, but you'll see that there's just massive amount of VIX volume on that event, right? So it forces hedging, and then all of a sudden it decays like it wasn't even there. And it's just an expiration mechanic. So yesterday, people say, you know, what happened? Why is the VIX doing this and that? And it's just simply expiration mechanics. And it's something that happens. So if you have your handy dandy notebook, right, and you're out there doing what I like to call trader scavenger hunt, you're learning how to trade. You're going through all your mentors and all the people that teach you something, all the people that have been around the block 10, 15, 20, 30, 50 years. And I love it because when I go on spaces a lot of the times, right? So one of my podcast spaces that I'm on Twitter is with the Street. So if you guys are familiar with the company The Street, they're amazing. There's a lot of really, really good, like the traders we all watched on TV when we were new to the game, right? Like you have Sar, Shim Guilfoyle, you have Jay Woods, you have Peter Tuchman. All these guys come on. And we sit next to them and listen to them talk, and I'm always taking notes. Like I'm learning from these guys still, like stuff that I didn't know, little nuances of the market. So if you guys are looking for little nuances, at least from what I brought to the table, is the third Tuesday of the month, don't fall asleep if you're an index trader. It's just something that you know, and like when I'm on this podcast and I talk with those guys, I'm always learning something new. Like, did you know this? Did you know that? I'm like, oh. I recommend that you write down any little nuances that you learn from people's 10, 15, 50, whatever years of wisdom. That's one of them. So what happens, and watch out, Nasdaq's flipping irrational today. Careful. Yeah, so that's one of the things. You can have a volatility event create something. So be very careful here. My options go to December 9th, so I'm in no hurry to do anything right now other than be cautious on maybe trimming so I can get in earlier. Now, one thing I want you guys to learn from me, if you guys don't mind, smashing that like button. If you haven't tried Rocket Scooter's stuff, I'm about to go through the platform. Please do. Go to our... okay, I'm waiting. Let me let these guys know about the data stuff really quick. Okay, we're looking into it. So what we did actually we did an expansion project this week to expand how much data we pull to compensate for the additional options that came through. One of the things that they're looking at now, so here's our data, it's coming through now. ED's about to pop up, is to see if we actually, our data providers can only handle so many requests for our calculations. So we just basically tripled the throughput of how much data we need because we're not only pulling more options now, but I told them to pull out more data for we're preparing for monthly map. So in monthly map, we need to pull more data further out in time. So we're double checking to see if we didn't just, essentially pull so much it froze everything. So we're going to double check that. Still learning to use Rocket Scooter and understand it fully. Awesome. Well, we'd love to have you here. So looks like we're getting some data finally coming through. And now it's good. So we're going to investigate that today. So this could have been my bad. All right, here we go. Yeah, now we got stuff. Okay. Resilience is negative. And of course, that is that start today where S&P half gap is resistance. When resilience is negative, you expect this to be resistance. That's it. When markets are rational, you're going to see that it will have not as much of a leading edge. When markets are rational, it will lead the market very easily. So I've done nothing today. Made no moves yet. This is a long entry. If you are a bull and you want to see resilience go above 0.396, back to here, I would trim and I would close here if I was long in this on a day trade. That's it. Amazing experience so far. Thank you, Tommy. DD comes in when these numbers are 90. So when we get the rest of the data pulled in, yeah, so he's investigating the servers. The one thing he doesn't do is reset it while we're live. So we're just doing some, looks like there's another chunk that came through. There's some kind of congestion. We're gonna have to investigate this and see. All right, so let's run the scanner. But yeah, we had some amazing updates, which is great. And it's super cool to see that we have a bunch of changes. The dashboard, hella sweet, right? It's really nice. That's the first batch of changes. I'll show you guys what it looks like. Account, change password, all your membership information, your billing and payment information, and then social links. So it's basically just kind of normal layout on a website, but it's all on the left side. So we got the little graphical changes there. It looks really nice. You're gonna have a few more things. You're gonna have right here, quick start guide, immediately get you started with where to go, how to join our Discord. Education is going to be where our videos are. Videos are going to be kind of in sequential order. Liquidity map will bring you to the liquidity map. Link right here. Watch the live stream takes you to the YouTube channel. And strategy guide will take you to the strategy area of the Discord, which will give you all the information for that as well. That's all pretty nice and organized. I love it. It's a really cool design. The guys really put a lot of work into that over the last couple months. There's also an upgrade membership area. So if you click on the top right of the dashboard, it'll say upgrade if you want to upgrade your membership, and that's pretty dope as well. How you guys liking your experience so far? Let's talk about it. Hedge pressure predicts volume right here. There's your volume. As you interact with hedge pressure, there is a volume spike. There's that long entry at 96. With the resilience less than 0, then 97 is that resistance. If the resilience goes above 0, we're popping through and likely flipping bullish. Anything above 398 is a bull breakout today. 398.5 is going to be resistance on hedge pressure on the monthly. So we are pretty much sandwiched between here with the liquidity pocket in the middle. The market's going to be nice and choppy all through here, and it's going to take all day to break if it does 398.5. So one of the things that you can do here is not only understand where pivots are, but you can actually predict volatility now, right? Because the market has a couple pathways, right? If we break through here, it's goodbye. Really bad. If it holds, there's a resistance there. There's resistance there. There is a liquidity pocket here. So it's going to want to go through the middle and go through the middle and go through the middle and probably just pick a direction. And if it does, it'll go one way or the other if it leaves the area. So it's going to be like this all day. You can predict that, right? So day trades, there's little scalps here. There's just scalps all day long. There's not going to be a market's going to open and rally without a catalyst. Let's see that. So moderators, when you get those, I don't know if you have the ability to do that, but when you get the those messages about the free girls in your city or whatever from those bots that post, you hide the user on the channel so that they don't show up on the chat. You don't have to just delete the message. If you click the little ellipses to the right, hide user on channel, then their messages won't be seen. Unless you guys want to see porno spam bots. Probably not even the good stuff, to be honest. DD should be coming in soon. We're very close, 89% almost there. Yeah, it's confirmed that it's our data. It's our data providers. Here's our DDs coming through, almost there. So yeah, when we started pulling more data, we likely congested it. So we're gonna have to write a congestion optimization. We did this the last time, so we're gonna do it. I got a little overconfident, and I told them, pull 3 times as much data. They're like, I was like, it's been clean. Let's try it. So this one's on me. So data's just coming through slow because we're pulling so much of it. Just kind of neat. But we're the only people that use this data provider to pull data like they do. We pull every piece of information on every option for every ticker that is traded on the S&P. Every ticker. I'm talking every single ticker. The moment the market opens. So like we turn on Wall Street's biggest fire hose for like 10 seconds, and then we have an army of server machines pulling this data to calculate your hedge pressures. So it's not a simple calculation. It is an entire automated system that took years to design to get all this data. Nobody in Wall Street does this. So hedge pressure is not just like, here's the data. It is a massive, massive, massive calculation just for one ticker. It requires so much data to come through. So since we're pulling from every corner of every penniest stock of the smallest ticker, of the smallest options, all out in time to do this, when you triple your data throughput, we probably just need to buy more data. So DD should come in 65. There we go. Make the liquidity map layer invisible then visible, and it fixes the MHP. If you refresh, it should fix it too once it came through. So what happens is we just had our data was congested because we pulled so much of it. Thanks, Flying Cat. So neat thing, right? Today's a big update. We're adjusting for those CBOE data, and actually it's not 398.5. That was yesterday's data. So it actually is 395. Okay, that's good to see. Let me make sure I make that note in Discord for everybody. Okay. That was yesterday's. Data. You know what? You know what's funny though, is because we are cutting edge technology, right? We are on the brink. When the CBOE, the day they change something, we have to modify and adjust and make something. Nobody does anything like what we do, so there's really no go by or pattern. So now we are bear long up on SPY. Let's talk about it. Let's get ready to go. We try to pull, and our data providers and I talk all the time because we're like a case study for benchmarking their service. Because nobody pulls what we do. A lot of the people that use our data providers are like these unusual folks, you know, like they do the unusual options and things like that, unusual activity. They use this data provider too. And we're the only people that pull in all this options data the moment the market opens for this calc, and that's it. So we pull at just magnitudes more data than any of their other clients. So we're always benchmarking and finding errors in what they do because we look at every corner when most people are only looking like what you have active on the screen. Then you're, so say for instance, you're using another one of our competitors, right? And they're a unusual machine software. Whatever ticker you have activated, that's probably all it's communicating with the live data pulls, right? With us, doesn't matter what you have activated. We've calculated all the hedge pressures because we need it for resilience. So they're not searching for like stock number 500 on the S&P and its options the moment the market opens like we are. And we're basically like, you know, kicking the guy that's guarding the warehouse. You know, he's taking a nap because there's like the warehouse that has Apple and Amazon and Google in it. And there's the warehouse that has stock number 399, 499, 500, and that nobody uses. And they have this guy that just takes a nap in case anyone comes over. You have to wake him up, ring the bell. He's like, wait, what? Oh, you need data from this warehouse? Well, nobody ever comes over here. Get up and run all the way to the back and come back with the data that you didn't cache. Now, market just opened. He's like, wait, what? Well, and then, you know, so essentially it's called cold caching, right? It's a thing that is prevalent when you're, you know, it's like if you order that one thing on Amazon that nobody buys, you're not going to get like arrives today by 2 p.m. for your shipping, right? They got to go find it. You know, it's not stored up in the front where the toilet paper is, right? And so the idea is in a similar sense with data, we have that. So when we start telling our servers and that guy that's sleeping, the security guy sleeping in the front, hey, we need 3 times as much data. He's like, oh, I got to hire more guys to go get it, right? So that's kind of a metaphor to explain like what happens when CBOE brings in more options. We got to search more data and data points. So this was the live test of that. And clearly we need to optimize. So that was on us. Okay. BRLU on SPY. By the way, everybody, rocketscooter.com, about to show you something very awesome. You want to see why SPY pivoted 396? Go check out our software. We'll have a special training session today over what this is. How we can predict volume. Look at that volume spike right here. What do these numbers do? And how can I trade with it, right? It's a brand new thing. You tired of technical analysis? You tired of using indicators that are trends and averages and colorful pictures that are ruining your retinas day by day? I know. Me too. What we do is we show you where buyers and sellers can be, like a market maker will be looking for liquidity. So will you. This is a map. This is a map. We colloquially call this the playbook, but essentially SPY, bear long up. Then bear long up is going to show me where all the buyers and sellers can be. That's it. So SPY opens in the bear zone, which is below green. And there are bears in this zone. This is bear zone. There are buyers and sellers, massive volume spike at both hedge pressure, which is blue, and monthly hedge pressure, which is yellow. When I'm trading something, I will only trade where buyers and sellers are known to be. If the market is moving on a catalyst, it's unpredictable no matter what you use. The market's just ebbing and flowing on a nice quiet day like today, no catalyst, no reason for it to move, then I'm looking for sellers and buyers based on what liquidity map is telling me. You can use 285. And again, if people are asking about the liquidity map, I'm going to teach you guys something really quick. Classic app, you can always try that for the data. You'll see right here. If you run monthly mode, the timestamp that returns shows you if the data is refreshed or not. You see what I'm saying? Yeah, the price of being on the forefront is we're the pioneers, right? So now we got to go talk to our data providers and let them know that they likely need to update their servers as well. So they, like I said, they like to use us as a case study for debottlenecking this one data package, because we basically come to them and say, anytime there's an upgrade, we're like, hey, by the way, a lot of times they'll email and be like, so how, how's it working? So normally, like the day like today, they'd probably contact us and be like, how are things going? Just because they know we're the ones stress testing their system, which is kind of cool. It's kind of cool to have that relationship with them, because they know if it works for us, it'll work for everybody. No, but we pull more data from them than in any client they have in Wall Street, which is great. Okay, so bear long up, bear long up. I'm looking for buyers. Then the only place I'm going to find buyers is either at the open or at hedge pressure. That's it. So if I were to circle both of those things, the market opens right here. There should be buyers. And there should be buyers here if I'm wanting to find buyers. Okay. So right here is where buyers are, and right here are where buyers are. That's it. Now, if buyers can be anywhere also, like anywhere, but it'll be random. The idea is that as the market's trucking along, you're not going to have 500,000 people all decide to just randomly long at the same time for no reason. The probability is really small. So what these are telling us, where these buyers will be and sellers will be, are all based on the science and math of how exchanges work. All we do is exploit what exchanges and market makers do. Completely different style of trading. So right here, where the open price is, anytime the market opens and closes, there's always buyers and sellers. And I'll show you what that is in a second. Hedge pressure is the net maximum unusual order flow, which we predict at the start of the day where that unusual flow will be. Most people will wait and you get that ding, 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 ding. Your alarm's going, oh, shoot, unusual flow. And we're like, it would have happened at 396 from the start of the day. And there it is, right? You know, for any stock, for anything, where unusual flow will be today. Here and here. Here's your unusual flow. Look at this. Nice volume decay. Then all of a sudden, ding, ding, ding. Unusual options, unusual order flow. Here's the tape. Here's the... And you're like, yeah, I know it was 396 all day long. I knew it was going to be at 396. And so the way that we know that and what happens here is it's the maximum order flow due to delta hedging of market makers zeroing out their risk and their positions. Our technology knows where market maker options are, and nobody in the world has that. It's brand new, and it's a paradigm shift in trading indicators. So what we do is if we know where buyers as a market maker is going to lower price to find buyers and raise price to look for sellers, if you know there's going to be order flow just because people are zeroing out their risk, there's your order flow. It doesn't mean it has to bounce there, but it means if it bounces, it needs to bounce there or else it's not bouncing anywhere else because that's the maximum order flow coming through. And you need some bulls to be there or some longs to be there if you want to be a bull. If that order flow comes through here and it jumps to the other side and starts resisting, then I'm out of the way. Does that make sense, everybody? Can I get a big old fat YES in chat if you understand what I'm saying? It's not predicting the market. People are like, we try to be fair. You cannot predict the stock market. You cannot predict the stock market, right? But you can predict high buying order flow. And the question is you're just showing people where the battle will be. This is the point of interest today. No junk on your charts. No histograms, profiles, trend lines, all this shit you used to put on your charts. Never again. My charts have always just looked just like this. I do all my trading like that. So again, I'm looking for where buyers and sellers can be. And so if I BRLU. So if I get there and it doesn't do this, I'm not hoping it longs anywhere else. I'm out of the way. What's up, Scooter Gang? Hey, what's up, New Age? How you doing, man? Right, so that's the point. It's if I'm trying to short right here where my mouse is, let me get a red for short, right? It means if the market is trading on a BRLD through here and I'm like, ooh, I want to short. I'm not going to short there. I'm not going to short there. I'm not going to short anywhere except for there because that's where that volume spike will come. And I'm saying is if there's the max amount of selling order flow, that's the best case scenario where I need sellers to be to support my position of being short. So say that I jump the gun and the market is like opening here and it fell like that and I short. I'm like, whatever, I'm a newbie trader. Let me chase that low and I'm shorting. Fuck, it's squeezed against me. I stopped out of my trade. Explain to me the two things I did wrong where I just drew. Is that really small? Let's make that bigger. That's super small. Let's zoom in, shall we? Do you have any questions about any of this or about me or about what we do, where I come from, which planet, which background, how long I've been trading? Would you guys want to know anything while I'm talking? Okay, it's a little bigger. Okay, say that market opens here and I jump the gun by shorting right at the bottom because I see a red candle. I'm like, ooh, bear market, let me short at the low. And then it goes right here and I get scared and I stop. What did I do wrong? Smack that like button for Matt putting on a free game for everyone. Bro, I love you. What is pocket pooper? So the idea is I shorted at the low and the market went up to this bounce point and I covered, right? A lot of you do this. You will chase the short, the market will go to where the sellers are and you'll close out of your trade. Then all of a sudden it takes off and you're like, ah, crap, right? So what you would do, what I would do differently if I just, woke up and I just was like, yeah, let me short the market, it's crashing. And then it went up to here. I wouldn't be scared to cover my position yet. I would actually, the correct thing is I would short again at that spot because there is a place where sellers can be and that will short with a very tight stop. Say I shorted like 5 contracts and it went to here. I'd probably short 20 more right there. As long as those 5 contracts don't blow up my account and it hits my risk tolerance that way. If I say I'm gonna lose 10% or 5%, as long as that's not too bad, I won't close out. Which means if I short at the low, I'm not shorting so much that this potential pivot squeezes me out before I fall. So an example is if I'm choosing to short at the bad spot, I know how much risk I'm going to take before I stop. So I can adjust the size of my position. And now you have a way to calculate risk and reward in real time with Liquidity map. And we designed the world's first risk management trading platform. Because if this was here and the distance to there where that pivot could be was enough to lose 40% of my account, yeah, I fucked up. So I will only chase that red candle with an amount that I know in the contingency of if it goes against me, then that loss is manageable or contained with what I'm willing to lose, right? So ideally, the average trader will short, get scared, market falls again, and then they'll chase that short again because, oh, I was right. Ugh, let me get back in. And all of a sudden they lost, and then it's a volatile market and they're getting squeezed the whole way down. It's really hard to trade. So instead, in this scenario, if I chase the short, I need to know that potentially it's going to try to find sellers against me, and that is the maximum I'm willing to tolerate to still be right. If we break through monthly hedge, I'm clearly not going to be short again because it can go really far against me. That's how this works. What is Pocket Pooper? I like that name though. The Pooper Squad. So now I can manage a position by understanding where buyers and sellers can be to support the way that I want it to go. That's it. So in this example, somebody's asking about bear long up, talking about SPY, talking about QQQ. Bear long up means, and you will see the letters update in real time. Here's how you read this. This is the bear side of the market. Let me zoom in and we'll show you some of the new features too as well. So we're going to go through here. I'll just show you how this works. Bear zone and bull zone is actually where the market's purely bearish and bullish for that thing. Again, this is something nobody out there has. Nobody has anything like this. This is a bull zone and bear zone distribution. As a matter of fact, if you look here on the walls, you can see that the SPY I have drawn right there. There is a clean split between bear and bull distribution. 398 is where market is bullish. Let me draw some green and red arrows. 397, market is bearish. So these are all bear positions. Right now, we are not bullish enough to create a rally. Bearish positions. We say BR for bear, and there's your BR for the letters. So you just have bears in bearish positions. People are not bullish until 398 or higher. So that is where the bull side of the market. It doesn't mean you can't have a squeeze. So don't be scared if you're trying to be bullish, or don't be like overjoyed if you're trying to be bearish. Hedge pressure and monthly hedge pressure have to do with automated hedging. If everyone took their hands off the wheel of the car, robots will be trading here and here to balance risk of all the options sold to market makers. That's what this is. Hedge pressure has this weird effect that when you get to it, it's a push or pull type scenario. If you think about it like a skateboard quarter pipe, right? It's a skateboard. There's like a little wall. There's a ramp. And as you're skating, here's your guy on the skateboard, right? He's going to go straight up and come straight down. Straight up and straight down. But if he puts like so much force or thrust on that skateboard, zoom, and then maybe gets a gust of wind and then lands on the other side, then he's stuck over here, okay? Volume spike, skate, volume spike, and then you're on the other side. When that volume comes, as you approach, you get that high volume spike. When that volume decays, whatever side you're on creates an exponential drift in the other direction. So that's how the pivots work. There is a maximum and minimum threshold that we look at of amount of hedging that takes place here. Above 396, you will just have more robotic long orders balancing the risk than you'll have robotic short orders. That's what hedge pressure does. On the other side, it points down. The other side, it points down. So the three different forces that you see are balanceable and liquidity map. So market makers are going to lower price to look for buyers. Hey, there's buyers. There's a green arrow pointing up. I should just draw it right here. Now do you see what I drew? Arrow down, arrow up, price down, price up. Do you see how you're just showing that? Yes, in chat, if everybody sees what we're talking about and you like this brand new technology that we created. We're a team of engineers. My background is chemical engineering. I am a data nerd. I used to write. Let me zip it on. I used to write reactor reaction models for Dow Chemical as a reaction engineer. I used to run acrylic acid monomer reaction units, 3 of them, make diaper absorbent, or a precursor for diaper absorbent. Huggies. That's right. That's right, ladies. What do you do for a living? Oh yeah, I make that. I make the monomer part of the powder that goes in the Huggies diapers. Ladies, line up for the Huggies guy. Can I buy you a drink, baby? I know how to cook the good stuff. That's right. The Heisenberg of trading. By the way, one of my favorite scientists, actually. A huge fan of quantum mechanics, by the way. On my YouTube algorithm, my girlfriend and I are hilarious, dude. Our YouTube algorithms make no sense. Half of my recommendations from YouTube are hilarious cat videos. The other half are very advanced, PBS style documentaries on quantum mechanics. I'm a huge fan of quantum mechanics, quantum uncertainty. Stop pooping in people's pockets, pooper scooper scooter. Pooping in people's pockets. I like alliterations, by the way. As a weirdo with a math brain, I love things that have alliterative rhymes like that. So it's pretty cool. Okay. So far, so good. Does everybody see how I drew this, right? It doesn't mean it has to do that, but it means on the bear side, there are bears, and on the bull side, there are bulls. And so as you see, if I were to just take some white lines and draw some pretend like some water hose that's flowing, right? So, I mean, you see that there is like a flow here that's going to hit a resistance here and likely do something and probably balance in the middle. And do you see it's doing exactly that right here? If it sandwiches or falls below blue, it's likely going to, again, stabilize in the middle. And then here is a massive breakout because you have bull pressure long, this guy long, and this guy long, right? So when you actually are to kind of take another layer to this long pressure is there. It's weaker the farther away you go, but it's still there. As you see above 398, bullish side, long from hedge pressure, long from monthly options, right? So this is very bullish. On the same side, on the downside, here is very bearish from there, there, and there. So if I were to kind of delete a lot of this other stuff, right, you can see that there are basically 4 possible pathways that make a lot of sense to a trader. And I'll show you guys even more stuff. So click that like button. Make sure you share the stream because I'll show you guys some more stuff. So if I were to just kind of draw where the forces are, and over here to the right, I'm going to draw what's really going on with big fat arrows. Okay, this is bullish right there. Tasty arrow. This is a market collapse right there. Easy to see that. Because here you have bull of all the letters. Okay, ready? Bull side is B. Above hedge pressure is L. And when hedge pressure is above monthly, this is just a one-time thing. It does not change. This is another mechanic. Just trust us on this. Don't try to learn why. You just say up. Less than is down. That's it. That's just all this is. So up means the orientation is up. Up is a little more bullish and bearish. Up means that the shorter term balance is at a higher spot than the longer term balance. It means people are more bullish in their options positions today than they were yesterday or over the course of the month. So we got like bull long up is that way, but essentially bull and long without even saying up or down, right? You're on the long side of hedge pressure, which means robots are going to be longing faster than they're shorting, just like I showed down here. It doesn't mean it predicts it has to bounce there. It means if I want it to bounce, it has to bounce there or else it's not bouncing anywhere else with any provable, predictable thing. I need a random catalyst or a random sell or a random squeeze or whatever. And it's a random Wednesday. Is today Wednesday? Wednesday. Okay, so on this side of the market, it's bear and short, right? You have bearish positions and short hedging to boost it. Bullish positions and long hedging to boost it. In the middle, there's just a bunch of choppiness, right? And so let's explain some of the choppiness, and I'm going to blow your minds with some more indicators. In here, chop, right? Chop balancing from here to here. So there could be a scalp, like if I was at 395.5 pop quiz, right? Market's at 395.5. Would you do anything as a trader? Enjoy, but Indian market will open tomorrow. We'll see tomorrow. Oh, what are you guys saying? I'm not reading chat. Would y'all do anything here because it's choppy? Probably not, right? Would you do something here, though, on the edge of monthly hedge pressure? Probably, right? I would probably build a swing off of there over a long period of time. If I wanted to day trade, say S&P futures or some zero-day SPY options at 395, I know that 396 is the best I'd want to hope for. And if it breaks through, well, hell, there's a great breakout. But say at 395 it falls and I want to long, I'm not going to buy zero-day 398s, right? There's a lot of chop you got to go through. And I'm expecting it to have that hard resistance. It's going to be a big fight that's going to take all day to try to break through. So I'm not going to be overly greedy. I might trade from here to there and then close out. So an example is the market. Oops, I deleted the S. Are you guys glad that I'm back? I know people are like, you sound so different on your laptop. When I'm on my laptop, it's like,
hey guys, welcome to the stream.
And I'm sitting in like this giant open space and everything. Now I'm back with my microphone. Everything sounds good or whatever. Okay. Just quickly, I'm going to take a quick break. So don't go anywhere. But I'm going to finish this off and show you. Inside of here, if the market were to dip to right there and do this, I would long 396 options calls right here. And the minute it goes to there, I'll just close them out for profit. If I want to be a maverick and bet on the small probability that we beat through this chop and go through there, I will close out most at the boundary because I'm expecting it to be resistance. And boy, if there's 0 days, I'm gonna be losing theta the minute it turns around, they go out of the money. So I want my options to be in the money as it hits that blue line. Unfortunately with SPY, this wouldn't be possible. But if that was 397, I would certainly buy 396 in the middle so they go in the money. When I get there, I close them all out. If you want to be that 10% or 11% chance hedge pressures do like to break, close out 80, 90% of your position. Hold a couple of them just in case it squeezes, right? So you don't buy a bunch and then bet that it rallies. You understand that these are mechanical pivots. And now I can basically draw out the entire day saying that all things being equal, no catalyst, no randomness, the market's likely going to ebb and flow in this direction. So let me plan my trades around it. And these calculations are done the minute the market opens. The minute the market opens, literally right at the start. And so I can now map out the day. So inside of here, chop, right? And again, I'm just going to show you. And it doesn't mean it has to do that, but it is like having a treasure map before you go looking for the treasure. And maybe there was an X on the ground on the treasure map, but when you get there, there's like rocks and trees. Maybe a little different. The landscape does change over time, and in real time, it does change as well. So it's the best you can do with what you have. So here it's chop, right? I'm gonna put CH. Actually, draw like this. Choppy. Here, bear resistance, bull resistance. Again, choppy. So I break it down in different regimes. This is a whole different conversation topic of what's called a liquidity pocket. Between bull zone and bear zone itself is also chop. And the bear zone and bull zone push the price to the middle very easily. It does not like to escape this middle that easily. The minute you hit a liquidity pocket, which is right here, we have a rule that says from that moment in time, the market is 100% random. There's a thing that happens in Wall Street. This is a secret mechanic that you're never taught about how markets open and close. I'm gonna take a quick bathroom break. Celsius is pushing its way through me. And I'm going to come back in like 2 minutes. Don't go anywhere. And I'll be right back. Don't go anywhere. We're going to show you the secret of what happens when the market's open. Right back. Hey, all right, I'm back. So far, so good, right? Liquidity pocket is a whole different concept. Basically, what it says is the bulls and bears are in equilibrium. Means all your bulls, which are people that want to be long SPY at 398, in the middle are actually upside down, right? And all the bears that want to be short below 397 are also upside down. The neat thing about liquidity pocket is the max squeeze point of all of Wall Street. So an example of what this is doing, if I were to long 398 and I'm like a massive buyer and I'm the only buyer at 398, and the market maker shorted against me, I'm a bull here and the market's down here. I'm losing the market. I'm losing the trade to the market maker. House is winning. And if you're the only bear at 397, you bear a bajillion shares short here and the dealers longed to your short. They're the ones that bought the puts there to hedge their long. Then in the middle, the bears are also upside down. Liquidity pocket is where buyers, which again, these are all your buyers and sellers, because these are the people that are holding, these are the market maker options, right? So if market maker has a put, it's because of this particular relationship. You long SPY, you're the only person longing SPY, and you long SPY and you long a lot of it, right? A lot of it. There's no seller. So there's a market maker, which is the other side of the trade. They are shorting that SPY to you because there wasn't a seller. And it's a lot. And they're like, well, there's a lot of buyers here with no sellers, which means market's bullish. We typically raise price to find sellers. Shit, I'm shorting while market's bullish. And they're like, well, we don't like that. So let's buy some calls in SPY to make sure that I can cover my short and equals neutral, right? They neutralize this process through a process called delta hedging. And so when we find the market maker calls, we know where the market was illiquid because there is a bull on the other side of that market maker trade with no seller. These are buyers with no sellers to match, or not a balance of sellers, no balance of sellers, where it's illiquid and the market makers are short SPY. Same thing down here. There's sellers with no buyers and it's illiquid, and market makers are long SPY. See how this works? So the neat thing about it is that the market makers are short SPY here and long SPY here. In the middle is like that double zero on the roulette wheel where the house is beating everybody. Right? So in a liquidity pocket, real buyers and real sellers are in close proximity to each other. The market will literally sit there all day long and do nothing if it has to. So the idea is a whole neat thing is that the market's entire goal, market maker's entire goal, is to just match buyers and sellers with each other. And here they are sitting, they're like literally like staring each other down in close proximity there. Pain, baby, pain. There's like things out there called max pain and things like that that use all the options and open interests and everything, and it tries to create something called max pain. It's 100% wrong. It doesn't do this. You have to isolate just options. You have to find illiquid, illiquid, and liquid. As you see, we don't consider all options. Our algorithm only looks for a certain type of trade. SPY options go all the way down to 350, 340, 330, 320. Why do we stop at 385 and why do we stop at 408? Is a completely different mechanic here. What they say, yeah, somebody said in pain right here is, you know, max pain tries to look for like where the max amount of puts and calls and things are. This is where the max amount of liquidity is, and the max amount of illiquidity is away from that. So let's erase a little bit and give you guys one little last thing, is that in the middle, caught mean reversion right here. And in here, the market is balanced. The minute you touch the middle one time, the market has found balance for the day. Now, if you look at previous day, if you look at S&P, you can see how volume is really high at the start of the day and volume gets lower as the day goes by. Markets tend to trade like this, and all stocks are like this. As the day goes by, you have like massive volume, and it gets like less and less and less. And then the last 2 hours of the day, the market tends to ramp up. Okay. And then you have a new day and you have a big volume spike, and it's the same thing in reverse. So you have a massive wave of buyers and massive wave of sellers at the open and close of the day. And so the market tends to gap down to facilitate an imbalance, right? So imbalance of buyers will probably gap up, imbalance of sellers will probably gap down. Market makers on the other side of that trade with puts and calls. And so ideally, every single day, this ebb and flow is a balancing act to redistribute that daily imbalance. Say that Monday at the end of the day, hedge fund A decides to buy a bajillion shares of SPY. Then day number 2, they got to find sellers to offload that short that they took to facilitate the buyers. So there's a redistribution area where dealers are just trying to like find buyers and sellers. So imagine today, pretend like we gap down because of a sell imbalance. The dealers are going to rapidly try to find buyers because people sold, the market makers bought from them. They need to find people to buy from them to offload that position, right? So you will see that when you gap down, the market tends to try to find areas where buyers can be. This is the mechanics of market making. And as you see, the market gap down and we are looking for where buyers can be because they are trying to find people to buy back from them. And here you go. That is that push that you got off of the gap down. So there's 2 mechanics going on. How do we know when the market gapped down that it was likely going to go down to find buyers? Is the indicator called resilience. What resilience does, and again, when you have that kind of J-shaped volume, the close and open are large volume spikes. So the price you open at and the price you close at are some of the strongest pivots of the day. And as I delete all of this in a second, I'll show you how that works. So when you gap down at that open price, which is why in liquidity map, the open price is typically seen as a pivot in every single one of these, it's there. because that open price is a bulk of buyers or bulk of sellers as well. This is a bulk of buyers and sellers, bulk of buyers and sellers, bulk of buyers, bulk of sellers. So we take all the places buyers and sellers can be, smash them together. Half gap is the balance point between that gap down process, which is here. So half gap has a predictive pivot indicator at the bottom called resilience. If resilience is negative, then half gap wants to be resistance. And as you see all day long, there's an additional pressure that sits on top of this liquidity map to give you even further understanding of granularity of what's going on in the market. So as I'm sitting here mapping it out, let's pick a different color for res, right? Let's do like a light gray color. If res is greater than 0, half gap, which is the halfway point. These are all of our indicators put in one place. Half gap is support. If res is less than 0, half gap is resistance. Because what happens is when you gap down, that halfway point is again another liquidity squeeze place. Remember, if the market rallies here at the end of the day, there could be a buy imbalance. And then all of a sudden at the open of the day, there's a sell imbalance, right? And the buy imbalance could be like a mil, and then sell imbalance could be half a mil, right? The market's gap down, there's still half a mil they need to redistribute. Market makers, people bought, some market makers are short the other half mil. They need to find sellers, so they're gonna raise the price to look for them. And you hit that middle, now they've redistributed some of the selling, and now the real effect of who bought and who sold is a balance point. At this balance point of the S&P, we look at a certain effect that goes on in all the stocks, and we can now tie break half gap using this indicator called resilience. As you see clearly, it's less than 0 for the S&P. So in another effect, you have a secondary pressure. This is arbitrage in the S&P, and it's a very, very, very powerful leading indicator. When markets are rational, resilience will predict very accurate. It's one of the only times we say the word predict what the S&P will do. Because the S&P, by design, tracks what the stocks are doing. Now, the SPY can trade on its own. For a little bit, it could deviate from the sum of the stocks and their activity. But in reality, it's like an airplane is on autopilot, and all of a sudden, you know, there's a headwind that's, or like a tailwind or something, a side wind, I don't know what you call it, I'm not a pilot, and starts to push the airplane off a course. The autopilot is going to try to push it back into course very easily, right? It's a counter pressure. It'll try to steer into it, right? It's a similar process. So what happens is the S&P is going to, as much as it can, when all things are being equal, if the S&P deviates from what the stocks say it should be valued, arbitrage machines will long one and short the other until they balance back out. So resilience is an arbitrage thing that also can show me resistances. And as you see, right out the door, it was positive as we moved, but it very rapidly dropped below 0 at the open of the day. And right here, you knew it was resistance. So as the market's playing around in this middle area and there's these green candles, we know not to chase that long because it's less than 0. It's not strong and above 0. All that matters is above 0, below 0. It's a rate equation. You see right here? Is there a resilient equivalent for futures to use the overnight? So that if you were listening to that entire speech I gave, remember resilience. I'll let you guys. I love to answer people's questions with a question. So why can't there be an overnight resilience right now, at least in 2022? It would be lovely, right? Crosswind, Flying Cat. Are you a pilot, Flying Cat? I should paste this picture in Discord for an example. Close, not that options don't trade. You're getting there. You're on the cusp of it. No, overnight the stock market's closed. You're not gonna have data. S&P adds up what all the stocks are doing relative to their gap downs, gap ups. Oh boy, I'm glad you guys are answering the question. Okay. Resilience uses no options data. Resilience is just stock data, stocks, no options. Monthly resilience has options, but in the same light, this is telling you what the stocks are doing in that redistribution zone relative to the S&P's price. If it's negative, then the stocks are losing more momentum, if you want to think of it that way, than the S&P. Imagine that if the S&P is here and the stocks are here and they're nice and pretty. Okay, stocks, S&P 500, okay? If the stocks start to move and the S&P 500 hasn't, and this is not what resilience does, but this is the best way to think about it, then the S&P likely needs to catch up with the stocks, right? In this scenario, res will be negative. It's the best way to understand it. If the stocks start moving lower and the S&P hasn't, then res will be negative. If they're all equal and the stocks start moving up and the S&P hasn't, then res will be positive. It's telling you the S&P where it needs to move to catch up with its actual implied value against its actual traded value. Example, if the S&P is nice and flat here, and then Apple rallied 5,000 points and the S&P hasn't moved yet, and Apple flew through, filled its gap, kept going, resilience will jump really high and indicate the S&P needs to rally to catch up with Apple. Or the other side of the coin means Apple needs to sell to catch up with the S&P, or all 500 stocks need to sell equivalently to catch up. It's arbitrage. So if you're a bull or a bear, you understand what the index is going to do, especially in an environment where all the stocks are tracking the index. So an example here, the stocks are not gapping up and going. The stocks are in this redistribution zone and resisting their own half gaps as well, and probably gap down, trade down more than anything. And there is no upward momentum of the stocks to pull the index. So while this is like options of SPY, options of SPY, options of SPY, options of SPY, this is the constituents of the S&P index and what they're doing. What's another mechanism that bulls buying SPY and bears selling SPY and hedging, longing SPY options and shorting SPY options? This is the SPY moving because Apple stock went up, or Facebook stock went down, or Goldman Sachs stock went up. So this has nothing to do with options. This has to do with the actual algorithm that the S&P tracks the sum of the stocks market cap weighted. So this is an arbitrage indicator that tells you if the S&P is undervalued or overvalued based on the rate of implied hedging. It's a whole different topic. It's in the resilience video of the stocks in the index itself. So despite options and options balancing act like we do here, resilience is an even much stronger indicator. Gives you even more understanding of the S&P besides its own traded pieces. So everything you see on the screen right here is called, so everything you see on the screen right here is based on options. So S&P SPY is equal to some function of SPY trading itself, right? If I go buy 1 million shares of SPY is going to go up, and maybe all the stocks don't have to go. They might, but they can sit there flat. I can make a demand for a traded instrument like SPY and push SPY up when the stocks don't go anywhere. But on the other side of the coin, if people sell the stocks, the SPX will immediately drop because it's just an index. But SPY may not drop yet. So remember, if the stocks sell, the SPX, which is just the index, it's just a calculation, will drop. But SPY may not react yet. And imagine this will all be balanced out in milliseconds because of the sophistication of algorithmic trading these days. But imagine it's the olden days where you have to do it all by hand. And all of a sudden, some fund sold 1 million shares of every stock in the index, and that just dropped and SPX dropped. SPY hasn't dropped yet. Market makers will start lowering the bid and lowering their ask to lower the price. And the next trades come through, they'll boom, 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 and it'll catch up. So we say that instruments like SPY are tradable. They can deviate because you can buy them and sell the other thing. Typically, people don't do that. But somebody can just be a fund that's only long SPY and nothing else. And they just dumped SPY to the market and then SPY started selling. Other firms can say, ooh, I probably should sell my stock too. SPY's tanking. Very rarely it happens that way. Usually the stocks move first. And if the stocks move first, the index will track it. And even if somebody was dumping SPY while another firm was buying all the stocks, right? Some firm out there will say, ooh, arbitrage. We're going to short the stocks, short all 500 of the stocks, and then long the SPY, and they're going to meet somewhere in the middle. And you hear the word arbitrage all the time. That's really what happens. In this entire process, we lump into a single word called tracking. Okay, there's a tracking protocol that two things happen. Either A, opportunistic traders will trade that arbitrage to bring them together, or the market making computers alone will just place their bid and ask appropriately without trades to what it should be, which is tracking. This is an exploit of tracking. If SPY trades off course, then resilience will tell you tracking is where it needs to go to catch back up. Okay? And it's very accurate because everybody wants to look for an arbitrage trade. It's such an easy trade that everyone does it. Not you and me. I'm saying everyone. Every high frequency trading algorithm out there is constantly searching for arbitrage relationships. I mean, didn't SBF, the crypto guy, make his original fortune off of crypto arbitrage? He would buy in the States and sell in Japan. There was an arbitrage trade. He made his fortune off of that before he went there and created FTX. Ugh. So ideally, what resilience is going to tell you is a second wave of pressure. Is that the gap mechanics and half gap, resilience being negative, is going to show you that half gap is resistance. So there's a second thing. And what this does is it goes to the close price, and this goes to the open price. Okay, open. Close and open price are specifically, let's make this smaller. You guys can see yesterday, are also pivots themselves. So resilience is a second pressure, if you may, that will show. Here is the close price. Let me see where it is. My little epic pen over here. Oh, y'all can see that, can't you? Let's put this on the screen. About 398.40. Here, this is the yesterday's close. And then this is today's open, right? So you can see that this is half gap is halfway in the middle, right? You can also see that every time you touch this close price here, here, there's also unusual volume, which I'll show you. But resilience just basically is a pressure from midpoint to close, midpoint to open. So as a trader, we look at it like that. So with resilience less than 0, this is resistance and it wants to push towards the open. And resilience is S&P less than 0. It wants to push towards the open to find buyers, which is what you're seeing right here. And that open price, which is here, is resistance, push to it, resistance, push to it, resistance. And you can literally see it right before your very eyes, why that resistance is pushing. And the open price is resistance because resilience is less than 0. You'll see that? You see how I'm not out here saying I'm going to buy hedge pressure, because at maximum I can only expect half gap to be resistance and likely the open price to be resistance. There's no R and R on that trade. So it's even further minimizing my choices. So let's read some of your questions, right? Is a stock calculation during tradable hours? Yes, that's correct. Blue, I just said. So resilience can only be calculated during hours because it's the only time the stock market's open that all your stocks are trading. So gotta wait for the query and calculate for DD and res. What about walls? Are they available pre-open? So when the market opens, Opera gives all of institutional Wall Street, like us and like anyone else, a data dump in the middle of the night. Markets are closed. We can create something overnight so you can have something pre-market. However, the secret to hedge pressure and walls is not open interest. That's the thing. A lot of times these options analyzer folks, they do, you know, they tell you all kinds of options, heat maps. I don't know. I've seen all kinds of technologies to try to look at options, and they try to do something along the same lines as what we do, which is a good step in the right direction. Options will predict a price at a point in the future. Options are the only thing that can predict the future because they're telling you where somebody wants to long and at what price and when they want to be long. If I buy a 300 call for this Friday, I've just announced to the entire world I'm a bull at 300 on Friday or before Friday. And when you look at everybody's desire to be long and short, including their desire to hedge and escape risk, you have a future looking projection, but the secret is not every option is meaningful. Your 2000 Tesla 0-day YOLO calls are so far out of the money, no one gives a shit about them. You just gave your money to Wall Street. They're not going to go in the money, right? There's a certain thing that market makers do, that they all do, that we figured out, and we extract just them trading to us in a region of balance like this. And that is the secret. So you have to wait until the morning to understand all the full effects of what we need to calculate. Can't explain what we calculate on the public stream, but I will tell you it's impossible to calculate until the market opens, because you can't physically have all the information about the options and the options trading until the market opens. The whole thing for that. But the minute the market opens, we're doing those calcs. And usually within 30 seconds, we start getting the index in. Within 1 to 2 minutes, they're all done. But they're all done at the reference point of market open. The overnight dynamic hedge pressures, fantastic. Liquidity map. Liquidity map in a bear market. When you say it's spotty, everything's spotty in a bear market. All your indicators will be spotty. Bear markets are volatile or irrational a lot of the times. In bull markets, you don't get irrational. You might go for like months without seeing a single irrational day. Irrational bear markets, when you're on the edge or anything happens that makes it irrational, all your indicators are going to be spotty. Irrational means market makers can't identify where liquidity is that easily. They don't know where buyers are. They don't know where sellers are. Irrational means it's hard for them to gauge. It'll be hard for you to gauge, which means if this is where they understand where buyers and sellers are as well, it's going to be hard to gauge when markets are irrational. Even one irrational flag, like today, UVXY hit that irrational trigger, right? The market loses its gauge on where buyers and sellers can be. And so in bear markets, the whole reason in bear markets, all of your trade room gurus and stuff are trying to short one day, long one day, short one day, long one day. And, daddy's sitting here, sitting out. Ooh, there's a squeeze. Oh, nope, not good enough. I need to break monthly hedge. Ooh, there's a squeeze. Okay, good. Long. I'm not trying to play the day trading game on guess today long, guess today up, guess today long, guess today up. I'm waiting for all the signals to line up to where it's not spotty. If you use it and it's spotty, then don't trade when it's spotty. Trade when all signals line up like I do. I haven't pushed any buttons today because it's spotty. You guys are over trading if it's spotty. The fact that it's spotty is a signal to sit out. That's the whole point. If everything doesn't line up, that's why you sit out. We give you indicators that say, sit the fuck out. Love you. That's the whole point. Spotty is like, I'm going to the pool today. All right. Less is more. People are nailing it. Status is just the number of monthly hedge pressure calculations that have been completed. That's it. It's just for me to eyeball if the data has come through or not. It's for you guys to eyeball as well. Doomsday starts to calculate once we have 90% of them. And then there it is. So resilience and Doomsday are considered accurate enough beyond 90% of the data. So you have 90% of the 500 stocks come in, and we pull them in order based on, you know, an algorithm. But essentially, the last 10% are so negligible they don't even really change it at all. So 90% is like when we say, okay, things are stable and coming through. That's what that means. Yeah, Tim, that's it. If it's spotty, that's the whole point. The whole point is when everything, like if I don't trade and don't trade, remember the tail end of the market is going to be very volatile and choppy, right? You guys saw me make a bunch of trades where I had that 70K week, and then I didn't do much but start positioning in Apple, Google, and Q. And now those positions as of yesterday were up 100K, which I showed you guys. And then I think I'm down maybe 30 something K on the positions as well, but I'm swinging them till December. Today I'm deciding, am I going to cut and run and get out or not, right? Take my profits or extend them out later. But I'm waiting, and I'm only trading when things line up because that makes sense. So again, today with resilience less than 0, even if I long anywhere, I know that at best, I'm going to be resisting the midpoint, but also resisting the opening price, right? So let me go ahead and delete some of these things. And I'm going to say that resilience less than 0 means that SPY wants to push to the open price. So instead of drawing, and I know we teach it like this, but in the redistribution range, which let me just draw differently. Again, these are all the pressures together. Like that's a prettier color. I hate neon colors. So there's all these options here. They're all neon. Ugh. Let's use maybe orange. I haven't used an orange yet. There's like hot pinks and purples in this drawing tool. Okay, redistribution zone. In the redistribution zone, res greater than 0. Actually, redistribution zone, RD. Which means that's the gap up and down. Dealers are trying to fulfill their obligation, the gap down. You have res greater than 0, pushes to close. Res less than 0, pushes the open. So these are all different trade ideas, right? This is that gap mechanics that market makers deal with. Now, outside of the redistribution zone, we don't have a name for it. We should probably come up with a name for it. But where you gap and go outside of the RDZ, resilience has a second function. And it's to tell you resistance, and I'm going to draw over here. Outside of the redistribution zone, which is below the open and above the close, resilience less than 0 outside of the zone, the gap down price, this is today's open, is resistance. Above the redistribution zone and res is greater than 0, then the open price is support. Or the close price or whatever. If you gap down, it's the close, gap up, it's the open. Do we all understand this? Today it's gapping down. So in the redistribution zone, resilience pivots just to the open and close for a day trade. Outside the redistribution zone, resilience pivots to the open as resistance. Do we all understand this? So right now, open is resistance, and it's very easy to see that resistance all morning long with resilience less than 0. So if you guys don't like our software yet, it's pretty fucking cool, right? So now I can squeeze out tons of trade ideas, swing trades, day trades, whatever, based on where buyers and sellers can be in principles of market making, gapping, things like that. Is your super sophisticated algorithm saying, check out my MACD, check out my colorful squares, snake pattern, elephant pattern, vomiting candle pattern, bullish flag, bearish engulfing. Modern trading algorithm exploits modern trading protocol, exchange algorithms, market making automation, delta hedging, things that you never heard of in your trading 101 book that you picked up at Barnes and Noble or from your trading guru who market gaps up in a catalyst and they're like, well, it looks like an engulfing, I don't even know what they're called, pennant flags, trapezoids, whatever, right? Jokes aside, exploitation of the modern mechanical market is what we're attempting to do. Things that if every computer in the world is doing it because it's the most efficient thing, then it's consistent. And consistency is how you create something that has rules to say choppy or spotty, okay? Sit out. We're detecting inconsistency. Sit out. In a bull market, you will have good signal, good signal. You'll have like long, 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 long. Ooh, get out of the way. Long, 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 long. Ooh, get out of the way. Bear markets, it's like, this point's up, this point's down. I don't know, but that's what volatility is. Volatility is an equation that measures the uncertainty of where people's escape point is on their hedging. If market makers won't know, you sure as hell won't know, and your colorful neon pink and blue and green fucking trend lines will definitely not know. The engulfing dinosaur tail. Yeah, right? So the idea is if you can't know, neither does Wall Street. You're literally closing your eyes and like throwing darts, right? So if you don't know, don't trade. Easy as that. And bear markets are hard to trade. Those of you that entered the trading game, I've been trading since 2010. Since the last recession. You guys are the babies of the group, probably. Some of you guys may be older and might be veterans of the group that even traded in the 2000 recession. I'm going to tell you what a recession looks like. It looks like shit. And whenever you're trading the market like you are in 2020 and 2021, it's like bullish, can't lose. Let's buy crypto. Let's buy stocks. Let's buy monkey cartoons. They're all going up. We're going to make money. All of a sudden, you're in your first bear market and you're like, oh my God, trading's so hard now. Welcome to Wall Street, guys. It is not going to be easy or clean or signals looking good. This is why you're watching your trade rooms melt away one at a time post-COVID, because everybody was a winner and everybody with 2 or 3 classes in their belt is now a guru teaching. Little by little, they all get exposed as paper traders, or they all just suck and people realize, man, they don't really know what they're talking about. The constant wins are no longer constant wins. And now they're chasing and flip-flopping with no real technique. That was me in 2010, except I wasn't teaching anything. I didn't know what I was doing either back then. And so the idea is that this is the wisdom. A real trader is going to tell you in a bear market, the best indicator there is indicator. So you just sit the fuck out of the market and wait for things to clean up. And then when things clean up and all the other kids and bad traders of the world are sitting there wondering what happened to their account, your money is intact. And when things clean up and lighten up, you're ready to attack with all your money in your pocket. Why do I have the unsexy answer when I sit on the spaces? Matt, what are you doing today? Nah, I'm sitting out. I sat out this week, sat out last week, didn't do much, couple scalps. And everybody's like, I shorted Tesla, I longed Apple, I shorted Roku. I'm just listening to all these people in their first year trading. I'm like, oh, that's cute. The more you do in a bear market, the more you're going to lose. Ultimately, it's against you. Ultimately, the max squeeze point of all traders is the house will always win the more you do. So you need to wait until everything lines up and then you act. And that's what I do. If you sit out the right time and attack when things are good, you don't need to try to nickel and dime 10 bucks, $1,000 bucks, $100. You see me, I made 50K profit yesterday, at least at the high, just on a swing because I waited months for the swing trade to pull up and look good. And then I took the trade, right? Net on that position is about 70K net right now. Net profit on Google calls, Apple calls, QQQ calls. That's it. So I'm not over trading in a bear market that's choppy. I'm swing trading further enough out in time that once I believe the market's going to stabilize, I'm gonna start getting nice and clean golden signals every day, and you're gonna see me day trade, day trade, day trade, day trade, day trade on top of letting that swing ride. So I know we're still not in the clear yet. We're having some clear days, which is great. Golden days, had a couple of them. One last week, I think one the week before. But imagine a bull market where like 9 out of 10 days are like golden setup, golden setup, golden setup. It dips to hedge, I buy, dips to hedge, I buy, dips to hedge, I buy. I almost get tired of taking that consistent trade, or at least more consistent, right? In bear markets, you know it's choppy, 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 choppy. I'm showing you, look, choppy at this balance point, choppy at that balance point. Nothing in here looks appetizing for a day trade. I've not said long or short anywhere in here. Right? All I'm doing is like, ugh, if we get down here, I'm probably going to close my swings out and push them out further. Now we follow, right? Okay, that's it. That's it for today. We're going to go to Zoom. Go to our Discord right now. Go to Zoom. In about 30 minutes, we'll open a Zoom session. And clients only. If you thought this is cool, just wait till we tell only our clients. Okay. Let me take a picture of this. Y'all want? You said I want a picture of this? Okay. Sure. Okay, let's go. Actually, let me delete some of the stuff that doesn't need to be here. Let's clean this up a little bit. And if you thought those indicators were cool, walls, hedge pressure, monthly hedge pressure, resilience. We have 14 more, 14 total. And I think I showed you 4. There's literally 10 more. They're just like that. They're all like, whoa, that's different. That's just a taste. I woke up today. No day trades look good. We're in choppy, resilience less than 0. Choppy, choppy, choppy. Market falls to here. I'm not choppy, choppy, choppy. Nothing looks great. Now, because nothing looks great, last topic. I can day trade in this chop. Sure, I can scalp here, scalp here, scalp here, scalp there, whatever. But I need to know I'm either day trading. I'm not day trading for a run. If I want to run, I'm swing trading so that it has plenty of time to exit this chop, which, you know, if you long options, is called theta burn. So if I wanted to frame a swing trade today, an example, monthly hedge pressure is a very, 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 very long-term indicator. We also have monthly expiring options on Friday. That if you're above monthly hedge pressure, we call it bull structure, bear structure. This is all of institutionals' long positions being hedged against, holding for months and quarters at a time. Your 401ks, your mutual funds, your IRAs, all those things that are long-only institutions that only buy stock with your money. This is your retirement accounts hedge pressure. They're not out there longing Apple, shorting Apple, longing Tesla, shorting Apple. No, there's buying stocks and then going to cash. Buying stocks, buying fixed income, going to cash. Buying, you know, whatever, but they're not shorting markets with your 401k. I can guarantee you that. So at the end of the day, this is the balance between your net long institutions and your net short institutions. Your hedge funds that are net shorting everything and your institutions that are net longing everything. They hold for months at a time. So in a swing trading sense, I want to maintain a long swing as long as we're hugging monthly hedge pressure as support. As a matter of fact, today's a day where if I really believed that I wanted to put more money into my QQQ, or pretend I had a SPY swing and we had this massive run up and SPY started falling and falling and falling, is down here at monthly hedge pressure. This is where I can add to my swing position right at the edge because I'm going to dump all of it there. I will cost basis average lower on my longer term December calls as we dip to monthly hedge. These are just tricks and tricks I picked up using Rocket Scooter. If you guys want to check out the free trial, map out your trades, risk management. I didn't even show you the scanner yet. It's like the cooler of the two things. So come to our Discord. It's free. If you have a Discord that you pay for, and all I do is like host text messages and calls and stuff. I mean, sure, but ours is free. Check it out. We're going to be in Zoom in about 30 minutes with a private Zoom call to go over a couple more things. And we will see you guys then. We love y'all to death. And thanks for tuning in. My favorite friends. Oh, Black Friday. Black Friday special. We are making our first, again, in general, our first 1,000 members are going to be half off for life, grandfathered in. It's like getting in the day the gym opens. Everyone will ask you for the next 10 years, how'd you get this $300 platform for $100 a month? You're like, well, I got in when we started. Check it out. If you like the content, $100 a month for the platform, your data feeds, everything else for life, forever. Send me a message in Discord after your free trial. Before your free trial is over, you get that locked in forever. Thank you guys for supporting the group, supporting the technology. We love you. Appreciate this demonstration. We'll be in Zoom in just a little bit. Free trial needs to be longer. It's 7 days. It's just to see if you want to learn it. $100 is like buying a book or two. So check it out. If a minimum, pay $100, you learn everything we have, and then you don't like it, you gained a whole lot of information. Like buying a book. Okay.